Okay, picture this. You finally hit that sale button on an investment you've held. Maybe it was a stock that, soared, or perhaps some mutual fund shares you'd been piling up for years. You see the money land in your account, and there's that little sigh of relief, maybe a quiet fist pump. And then almost immediately, your brain goes, oh, right, taxes.
Exactly. And that simple transaction suddenly feels like a tangled mess.
Yeah.
You sold it for this amount, but the big question is, what was your starting point? What did you really pay for it, in the eyes of the IRS? Was it just the initial dollar amount?
Yeah.
What about every time a dividend got reinvested? Does that count? And if you sold some shares, but not all, like which ones were they? The first ones, the most expensive.
Exactly that moment, that feeling of, okay, how do I match this sale price to a cost? That's where the complexity of investment taxes really hits home for so many people. It feels kind of daunting to piece together the history of an investment just to figure out the number that actually matters for calculating your gain or loss. And let's be blunt, getting that number wrong can mean you're either paying more tax than you legally owe, or maybe worse, less, leading to headaches down the line.
It's not just some administrative detail, right? It's the fundamental figure that determines your capital gain or loss. That's what gets taxed. Understanding it correctly is, well, it's crucial for accurate reporting and, frankly, minimizing your tax bill over time.
So that's precisely what we're digging into today. We're trying to cut through the confusion around this whole concept of your investment's cost basis. We'll explore why it's so vital for your U.S. taxes, how the financial institutions you invest with report this critical info, especially on that ubiquitous form 1099-B,
Right.
and hopefully empower you with the knowledge to look at your investment transactions and tax forms with, well, a lot more clarity.
And we're basing this deep dive on a stack of pretty solid sources. We're looking at guidance straight from the horse's mouth, the IRS, specifically their publication 550 on investment income and expenses. We'll draw on some foundational definitions from places like Investopedia and get some practical insights into how the industry actually handles this from like AllianceBernstein and Gainskeeper. They specialize in this tax reporting stuff.
Think of it as taking those, sometimes dense documents and boiling them down to the absolute essentials you need to know. Our mission today is to clarify what cost basis is, understand how your broker reports it, and maybe where they don't explore the surprising ways it can change over time.
Yeah, the adjustments.
Exactly. And perhaps most importantly, understand the different methods you can actually use to calculate it when you sell. It's all aimed at making you feel a bit more in control of your investment tax situation.
Yeah, the goal is really to replace that sense of dread when the tax forms arrive with more of a sense of, okay, I get this, I'm prepared.
So let's lay the groundwork. What exactly is this cost basis we keep talking about? The sources give us a very clear starting point, thankfully.
At its most fundamental, cost basis is simply what you paid for an asset. Pretty straightforward, right?
Yeah.
When we talk about investments like stocks, bonds, mutual funds, it's the amount of money you actually shelled out to acquire them.
Okay.
And importantly, this isn't just the share price itself. It includes any commissions, fees, or, other costs directly tied to buying that specific security. Investopedia and AllianceBernstein both frame it this way. It's the total price of acquisition. And you'll often hear it called the tax basis because, well, this is the number used in tax calculations to figure out your gain or loss when you eventually sell.
Okay, so it's the full all-in cost to get the investment into your portfolio. Seems straightforward enough if you just buy shares once and then sell them all later, right? But the sources quickly show us it's rarely that simple in the real world. The initial cost basis is just the beginning. There's also this concept of an adjusted basis.
Exactly. That cost basis isn't necessarily set in stone forever. The term adjusted basis refers to that original cost basis after it's been modified, adjusted, to reflect certain events that happen while you own the investment. Investopedia puts it nicely. It's the accounting cost adjusted for these events during ownership. It basically acknowledges that the nature or value of your investment, or maybe your total economic outlay in it, might change over time, and the basis needs to reflect that reality for tax purposes.
Okay, so what kind of events trigger these adjustments? What makes the basis change after you've already bought the asset?
Well, the concept applies pretty broadly to different types of property, not just your stocks and bonds. If we look broadly, Investopedia points to things like capital expenditures on physical property. So spending money to improve a building adds to its basis.
Right, like putting on a new roof.
Exactly. And conversely, things like depreciation for business property would decrease the basis over time. to reflect wear and tear. Now, obviously, adding an extension to your house isn't directly relevant to your stock portfolio.
Right, you're not depreciating your mutual funds.
No, exactly. But the principle is the same. Events that change the nature of the value represented by your investment can change its tax basis.
Okay, but for financial securities, there's a hugely common event that almost guarantees your basis will change, and it's one I think many investors might not immediately connect to their cost. Reinvested dividends and capital gains distributions.
Oh, yeah. This is arguably the most critical adjustment for the typical investor holding dividend-paying stocks or mutual funds. When an investment pays out income or capital gains, you usually have a choice, right? Take the cash.
Or buy more shares.
Or automatically use that money to buy more shares of the same investment right there in your brokerage account. Now, if you choose to reinvest, and this is the kicker, the sources are crystal clear, these reinvested amounts are considered income to you in that tax year, even though you never saw the cash directly.
So you get taxed on it. You'll probably see it on a Form 1099 DIV or something.
Exactly. You'll typically receive a Form 1099 DIV reporting this taxable income. So because you're taxed on those reinvested amounts, they're treated as income, it's effectively as if you received the cash and then immediately turned around and used that cash to buy additional shares.
Okay.
So for tax purposes, those reinvested amounts represent an additional investment you've made in that security. Therefore, the amount of the reinvested dividend or distribution gets added to your cost basis. It increases your overall basis in that holding.
And this is where that Investopedia example is so helpful, I think, in showing the real-world impact. Let's walk through that step by step, because it really shows why this matters for your actual tax bill.
Absolutely. It's a great illustration. So imagine you make a simple initial investment.
Yeah.
You buy 100 shares of something, stock, mutual fund, whatever, for a total cost of $1,000. Your initial cost basis is obviously $1,000.
Got it.
Now, over the next couple of years, instead of taking cash dividends, you opt to reinvest everything. Let's say in year one, you receive $100 in dividends, which are immediately used to buy more shares. Then in year two, you receive $200 in dividends and capital gains distributions, which are also reinvested into buying more shares.
Okay, so your original cash outlay was $1,000, but now you actually own more shares because of those automatic reinvestment.
Precisely. Now let's fast forward. You eventually decide to sell all your shares, the original ones, plus all the little bits you got from reinvesting, and you sell them for a total of $1,500.
Okay.
Now, if you mistakenly used only your original $1,000 purchase price as your basis, you'd calculate your taxable gain like this. Sale price, $1,500, minus original basis, $1,000, equals $500. You'd report a $500 capital gain.
Which sounds simple, maybe even logical at first glance, but it's wrong, because it totally ignores those reinvested amounts you already paid tax on.
Exactly. You must use your adjusted basis. Your adjusted basis is your initial $1,000 investment, plus the $100 in reinvested dividends from year one, plus the $200 in reinvested distributions from year two. So your adjusted basis is $1,000 plus $100 plus $200, $1,300.
Okay, so using the correct adjusted basis changes the calculation significantly.
It really does. Your taxable gain is the sale price, $1,500, minus your adjusted basis, $1,300, which equals only $200.
Wow, look at that difference. Just in that simple example, correctly accounting for those reinvested dividends drops your taxable gain from $500 all the way down to $200. That's a $300 difference in the amount subject to tax.
Yeah.
Depending on your tax bracket, that could mean a noticeable difference in the actual tax dollars you owe on that sale.
And that's the crucial takeaway here. Reinvested dividends and distributions aren't just like free shares that magically appear. They increase your cost basis because they represent taxable income being put back into the investment. Failing to add them to your basis means you will overstate your capital gain or understate your loss when you sell.
Meaning you pay more tax than you should.
Exactly. It's one of the most common mistakes investors make, honestly. Correctly tracking these adjustments is absolutely vital for minimizing your tax liability over the long run.
So it's not just tedious record keeping for the sake of it. It directly impacts your bottom line come tax time. That one example alone really makes the case for paying close attention to those statements showing reinvested dividends.
Absolutely. It transforms something that might feel like a small detail into actually a key part of your tax strategy. And this leads us right into how your broker helps, or maybe used to help with this reporting, which brings us to the all-important Form 1099-B.
Right, because while we need to understand cost basis, ultimately it's the broker who handles the sale and, crucially, sends the forms that go to us and the IRS. And Form 1099-B is the central document here, isn't it?
That's correct. According to IRS Publication 550, whenever you sell certain types of investment property, stocks, bonds, mutual funds, options, that kind of thing, through a brokerage account, the broker is required to report the details of that sale. They do this using Form 1099-B, proceeds from broker and barter exchange transactions. This form is your official record of the sale, and a copy goes straight to the IRS.
And our sources point out that the landscape of what brokers report on that 1099-B, specifically regarding basis, changed significantly because of legislation. There was a pretty important date involved.
Yes, a very important date. AllianceBernstein and other sources really highlight this major shift that became effective January 1st, 2012. Tax legislation, I think it was the Energy Improvement and Extension Act of 2008, but it got reinforced, introduced new, much stricter reporting requirements for brokers. That date, Jan 1, 2012, is basically the dividing line.
Okay, and this is where those terms covered and non-covered securities come into play.
Precisely. Under these rules, securities that you acquired bought, or otherwise received on or after January 1st, 2012, are classified as covered securities. Securities you acquired before that date are considered non-covered or sometimes uncovered.
And that distinction is fundamental to what information you can expect to see on your 1099-B and, maybe more importantly, what you're still responsible for tracking yourself.
Exactly right. For those non-covered shares, so anything you bought before January 1st, 2012, the broker's reporting obligation is pretty limited. As AllianceBernstein notes, for these older holdings, the broker is generally only required to report the gross proceeds from the sale. That's usually Box 1D on the 1099-B.
Just the sale price.
Just the sale price. They do not have to report the cost basis, which would be Box 1N, or whether the gain or loss is short-term or long-term. The responsibility to track down the cost basis for those pre-2012 shares, including all those potential adjustments like reinvested dividends over the years, and then calculate the gain or loss, that falls entirely on you, the taxpayer.
Oof. So if you're selling shares you bought way back in, say, 2005, your 1099-B will tell the IRS how much money you got from the sale, but it'll likely have a blank space or say basis not reported for the cost basis part. You literally have to go digging through old shoe boxes or digital archives for purchase confirmations, statements, dividend records.
Yep.
It really highlights why hanging on to those old records is still so important for long-term investors.
Absolutely. It's a real legacy issue for many people. Now, flip side. For covered securities, those acquired on or after January 1st, 2012, the reporting rules are much more robust. Brokers are required to report not only the gross proceeds, but also the cost basis, usually Box 1N on the form sent to the IRS.
Okay.
They are also required to report whether the shares sold resulted in a short-term or long-term gain or loss, which you'll see in Box 2. So this information is now right there on the 1099-B form you receive, which definitely simplifies the reporting process for these newer acquisitions.
That sounds like a huge relief for investors, honestly. What was the main driver behind making brokers responsible for reporting basis on these covered securities? Why the change?
Well, the clear intention, or the perspective of the IRS and Congress, was definitely to improve tax compliance. It's about closing the tax gap. By providing both the taxpayer and the IRS with the cost basis information directly on the 1099-B, it just makes it much harder for errors, whether they're accidental or intentional, to occur in calculating gains and losses. It provides a clear trail for the IRS to verify the numbers reported on tax returns.
Makes sense. It sounds like a great system in theory, more transparency, less guesswork for the taxpayer on newer holdings. But I can only imagine this created some significant complexity and challenges for the brokers themselves, right? Having to track all this.
Oh, absolutely. It did, and it continues to. GainsKeeper, which is a service focused specifically on this problem, really sheds light on the substantial logistical hurdles brokers face. I mean, imagine tracking the purchase date, the price, and the constantly adjusting basis for millions, maybe billions, of individual shares across potentially millions of customer accounts every single day.
Wow.
And this basis isn't static, remember. It needs constant adjustment. Corporate actions are a huge factor here, things like stock splits, where one share suddenly becomes two, having the per-share basis.
Right, or mergers.
Mergers, exactly, where shares in company A get exchanged for shares in company B, spin-offs where a piece of the company is handed out to shareholders, even seemingly simple things like return of capital distributions. All these events require recalculating the basis of every affected investor's holding.
So the broker isn't just recording that initial purchase cost from years ago. They're trying to apply all these complex, sometimes confusing events to maintain an accurate, up-to-date basis for every single covered lot somebody owns.
Precisely. And the information needed to make these adjustments often comes from the issuing companies themselves, and that info might be delayed, it might be incomplete, sometimes it even needs corrections later on. Gainskeeper points out that brokers often need to perform these basis adjustments daily, and sometimes, if new information comes in from the issuer after the fact, they might need to make retroactive adjustments to basis calculations that were already done and maybe even reported.
Yikes. So the basis reported on your 1099-B for covered securities is essentially the broker's best effort to track and adjust based on the information they have at that moment. Sounds like there can still be edge cases or complexities, especially maybe if you move assets between different firms.
That's exactly right. Transfers of assets from one brokerage to another are definitely another challenge point. Ensuring that the complete, accurate basis information for covered securities gets correctly transmitted from the old broker to the new one, well, that process isn't always seamless. It can sometimes lead to basis discrepancies that the investor might need to help resolve. So while the system is designed to be much, much better for covered securities, it's not totally foolproof. For the investor, it means the 1099-B is incredible.
That makes a lot of sense. The 1099-B is a great starting point now, definitely better than before, but it's built on a really complex system running underneath. Okay, now let's get to another really interesting and impactful area the sources cover. What happens when you sell some, but not all, of your shares in a specific investment, especially if you bought those shares at different prices and on different dates over time? This is where cost-basis accounting methods become crucial, and you actually have choices that can significantly affect your tax bill.
Yeah, this is a key piece of the puzzle, and honestly, where some strategic decisions can come into play when you've accumulated shares of the same security over time, maybe through regular investing, dividend reinvestment, whatever. You essentially own multiple lots, right? Each lot has its own purchase date and its own cost basis. So if you decide to sell only a portion of your total holding, the IRS needs a rule or a method to determine which specific shares, which of those lots, are considered to be sold for tax purposes. Your choice of method here dictates which cost basis you use for the shares you sold, and that directly impacts your gain or loss calculation, and also whether that gain or loss is considered short-term or long-term. It's a big deal for taxes.
And your broker applies one of these methods when they report the basis on your 1099-B for those covered securities, right? Even if you don't explicitly tell them which one to use.
That's right. For covered securities, brokers have to report a basis. So unless you provide specific instructions to sell specific shares or maybe set up a standing order for a particular method, they will use a default method. AllianceBernstein, for example, specifically states that their default method for mutual fund shares is typically the average cost method.
Okay, let's break down that average cost ACST method first, since it's mentioned as a common default, especially for mutual funds. How does that one work?
The average cost method is pretty intuitive, particularly for mutual funds, because you often buy fractional shares and accumulate them slowly over time through, say, monthly investments or those reinvested dividends we talked about. This method essentially pools together the total cost basis of all the shares of that specific mutual fund you own, regardless of when you bought them.
Okay, lumps it all together.
Yeah, exactly. You then divide that total cost basis by the total number of shares you own to arrive at a single average cost per share. When you sell some shares, you just use this average cost as the basis for each share sold.
IRS Publication 550 gives a pretty clear, simple example of this principle, doesn't it?
It does. It's helpful. Imagine you've made several purchases of a mutual fund over the years, and after accounting for all your investments and reinvestments, you now own a total of 300 shares. And let's say your total adjusted basis for all those 300 shares adds up to $4,800. To find your average basis per share, you just do a simple division. Total basis, $4,800, divided by total shares, 300. That gives you an average basis of $16 per share. Now, if you decide to sell, say, 150 of those shares, your cost basis for that sale, using the average cost method, would be 150 shares multiplied by that $16 average basis per share, resulting in a total basis of $2,400 for the shares you sold.
Got it. So every single share you own of that fund has the same $16 basis in this example. And when you sell, you just use that average. It definitely seems simpler than trying to track, did I sell the shares from 2015 or the ones from 2018?
It certainly simplifies the accounting part, no question, which is why it's often the default for mutual funds. The average basis per share applies to the shares you sell, and it also remains the basis per share for the ones you keep holding, at least until you buy more shares or have some other basis adjustment. However, While it is simple, it might not always be the most tax-efficient method compared to some of the other choices available for covered securities.
Ah, yes, the alternative methods. The sources list several options you can choose instead of just letting the default happen, whether it's average cost for mutual funds or often FIFO for stocks if you don't specify. These sound like they give you much more control over the tax outcome of a particular sale.
They absolutely do. For covered securities, you can typically instruct your broker on which specific lots you want to sell, or you can designate a different accounting method as a kind of standing instruction for future sales of that security. AllianceBernstein and other sources detail several of these alternative methods. They give you levers to pull, basically.
Okay, let's go through some of the most common or maybe strategically interesting ones. First, in first out, or FIFO, that's a pretty standard accounting principle, right?
Yes, FIFO is fundamental. It assumes exactly what the name says. The first shares you acquired are the first shares you sell. So if you bought shares on date 1, then more on date 2, and more on date 3 under FIFO, any sale would first draw from the shares you bought way back on date 1. Once those are gone, it moves to date 2 and so on until your sell order is filled.
And that directly impacts the holding period, obviously.
Critically, selling the oldest shares, the ones acquired first in, means you are much more likely to realize long-term capital gains or losses, assuming you've held the investment for over a year. And as most people know, long-term gains are typically taxed at lower rates than short-term gains, which get taxed at your ordinary income rate. So, FIFO often results in that more favorable long-term tax treatment if you've held the investment for a decent amount of time.
Okay, that makes sense. You sell the first ones you bought. Simple logic. What about the opposite?
Well, there's last in, first out, or LIFO. This method, again, does what it says. It assumes you sell the shares you acquired most recently first. Using our same example, bought on dates 1, 2, and 3, a LIFO sale would draw from the shares bought on date 3 first, then date 2, and then date 1 if needed.
Okay. Why choose LIFO?
Honestly, it's less commonly chosen for tax purposes for investments compared to others. Selling the most recent shares is much more likely to result in short-term gains or losses, especially if you've been buying regularly, because you're selling shares you probably haven't held for very long, maybe less than that 1-year mark.
Right. Okay, now the ones that sound potentially more strategic, high cost first out, HIFO, and low cost first out, LOFO. How do these work, and why would you pick one over the other?
Yeah, this is where tax planning can get really specific and potentially powerful. HIFO stands for high cost first out. With this method, you specifically instruct your broker to sell the shares you own that have the highest purchase price and therefore the highest cost basis first, regardless of when you bought them.
Okay, highest cost goes out the door first. What's the strategy there?
The strategy is generally tax minimization in the year in the sale. By selling shares that have a high basis, you minimize the difference between the sale price and that basis. This results in realizing a smaller taxable gain, or perhaps even realizing a larger deductible loss on that specific transaction right now.
Okay, let's use a quick example for HIFO, because this seems important. Say you own shares of the same stock, bought in 3 separate lots over time. 100 shares at $10 per share, another 100 shares at $20 per share, and a third 100 shares at $30 per share. The stock is currently trading at $25. If you decide to sell just 100 shares using HIFO, which ones get sold?
Under HIFO, you would target the lot with the highest basis. That would be the 100 shares you bought at $30 per share. Your basis for those shares is $30. Selling them at the current market price of $25 results in a $5 per share loss. $25 sale price, $30 basis, E is $5.
Oh.
So for that sale of 100 shares, you'd actually realize a $500 capital loss. 100 shares and then it's $5 a share. This loss could then potentially be used to offset other capital gains you might have, or even offset some ordinary income up to certain limits.
Wow, okay, compare that quickly. If you had used FIFO in that same scenario.
FIFO would mean selling the first ones you bought, the $10 shares. Yeah. Selling at $25 means a $15 per share gain. $25 equals $15. That's a $1,500 gain.
Big difference. And average cost.
Average cost here.
Yeah.
Let's see, total basis is $1,000 plus $2,000 plus $3,000, $6,000 for 300 shares. So the average basis is $20 per share, $6,000 per share. Selling at $25 with a $20 average basis gives you a $5 per share gain. $20, $5. That's a $500 gain.
Okay, that example makes it incredibly clear how powerful that HIFO choice can be in this situation. It turned a potential gain into a loss. So HIFO is generally about minimizing gains or maximizing losses today. What about LOFO then? The opposite.
Exactly. LFO is low cost first out. With this method, you're doing the reverse.
Hmm.
You sell the share you own that have the lowest purchase price and thus the lowest cost basis first. Using our same example, 100 shares at $10, $100, $20 at $30, stock price still $25. If you sell 100 shares using LFO, you target the lot with the lowest basis. It's the 100 shares you bought at $10.
Right.
Your basis is $10 per share. Selling them at $25 results in a $15 per share gain. $25 equals $15. For that 100 share sale, you'd realize a $1,500 capital gain, the largest possible gain in this scenario.
Okay, so low FO results in the largest taxable gain or smallest loss on that specific sale. Why? Why would anyone choose that? Seems counterintuitive.
It does at first glance, but there can be strategic reasons. For instance, imagine you have significant capital losses from other investments that you realized earlier in the year. You might want to offset those losses with capital gains so they don't just carry forward potentially unused. By using low FO or maybe SLID, which we'll get to intentionally select low basis shares, you can generate gains specifically to be absorbed by those losses. This could effectively use up the losses without you actually incurring additional tax liability for the year. It's definitely a more specific strategy, maybe less common for typical investors just selling shares, but it can be part of a broader tax loss harvesting, or in this case, gain realization plan.
Gotcha. It's about managing your overall tax picture for the year. Are there other methods mentioned, like by AllianceBernstein?
Yes, they also list one called LGUT, which stands for loss gain utilization. This sounds like a more automated strategic method that some brokers might offer. It basically directs the broker's system to select shares for sale based on parameters you define, like maybe prioritizing shares that result in losses first, or maybe targeting specific types of gains, long-term versus short-term. It considers both the basis and the holding period to try and achieve a desired tax outcome automatically.
Interesting. And then there's the method that seems to give you the absolute ultimate control, specific lot identification or SLID.
Yeah, SLID is the most flexible, but it also requires the most active management from you, the investor. With specific lot identification, you don't rely on a default method like average cost or a predefined rule like FIFO or HIFO. Instead, at the time you place your sell order, you specifically tell your broker exactly which shares you want to sell. You identify them usually by their purchase date and maybe even the cost. For example, you'd say, sell 100 shares of XYZ stock that I acquired back on June 15th, 2018 for $12 per share.
So you pinpoint the exact shares.
Exactly. This allows you to handpick the shares that result in the precise gain or loss amount and the precise holding period, short-term or long-term, that you desire for that specific sale. It's completely tailored to your current tax situation and goals. Maximum control.
Okay, so we have the defaults like average cost, often for mutual funds, and maybe FIFO, often for stocks. And then we have these elective choices like LIFO, the strategic HIFO, and LOFO, maybe automated LGUT, and the totally granular SLID. This clearly shows that the choice of method isn't just, some minor paperwork detail. It's a really significant tax planning lever you can pull.
It absolutely is. The method you choose, or fail to choose and thus get the default, directly determines the basis reported on your 1099-B for covered shares, and therefore the gain or loss calculation for that transaction. Choosing methods like HIFO or using SLID to cherry-pick specific high-cost lots can dramatically reduce your taxable gain or increase your deductible loss in the year of the sale compared to just letting FIFO or average cost happen. That can mean real money saved on your current tax bill.
But there's a catch, right? Or maybe a consideration for the future.
Well, yeah, it's crucial to remember that this choice also affects the basis of the shares you don't sell, the ones you keep. If you sell off all your high-cost shares now using HIFO to minimize today's tax, the shares you have left in your account will naturally have a lower average basis. That means a future sale of those remaining shares is more likely to result in a larger taxable gain down the road.
So it's not just a decision for today. It impacts your portfolio's tax profile going forward. It really requires thinking strategically, not just tactically, for this one sale.
Precisely. And the sources, particularly AllianceBernstein, really reinforce this point. They strongly recommend that if you're unsure which method is best for your specific situation, you should absolutely consult a qualified tax consultant or advisor. The optimal choice depends entirely on your individual financial circumstances, your income level, your other investments, any other gains or losses you might have, even your future income expectations or retirement plans. It's just too important a decision, with too many potential ripple effects, to make without fully understanding the implications.
That's excellent advice. It really highlights that while the rules have made basis reporting more common and maybe seemingly simpler on the 1099-B, the planning around it is still quite complex. Okay. Let's broaden our scope just a bit as we head towards the end. The sources also touch on other scenarios where basis comes into play or is determined differently, and maybe the final forms you'll use to report all this stuff to the IRS.
Right. IRS Publication 550 is, like I said, pretty comprehensive. It covers situations beyond just buying and selling shares yourself. For instance, the basis of property you receive as a gift or property you inherit is handled differently than property you purchase.
How so?
Well, if you receive property as a gift, its basis for you is generally the donor's adjusted basis at the time they gave it to you. It kind of carries over.
Yeah.
There are some special rules, though. If the property's fair market value is actually less than the donor's basis when they gave it to you, or if gift tax was paid, but the general rule is carryover basis.
Okay. Carries over from the giver. What about inheritance?
Inheritance is usually different and often more favorable. If you inherit property, its basis is typically stepped up or sometimes stepped down to the fair market value of the property on the date of the person's death. Or there's an alternate valuation date sometimes used. But the key is it's generally reset to the market value at death. So in these cases, your basis isn't what you paid, nothing, or even what the original owner paid. It's a value assigned by tax law based on how you acquired it.
That's a really key distinction. Gift basis often carries over the original cost and holding period, while inherited basis gets that step up to market value at death. That has huge implications for future capital gains if you sell.
Absolutely huge. Selling inherited property often results in minimal capital gain, especially if you sell it relatively soon after inheriting, because your basis is close to the current market value. Selling gifted property, on the other hand, might result in a much larger gain if the donor held it for a long time and its value appreciated significantly since their purchase because you inherited their low basis.
Okay, good to know. What about trading activity? There's a specific rule folks should be aware of called the wash sale rule that messes with basis, correct?
Yes, definitely need to watch out for this one, especially for active traders or even just investors who might sell something at a loss and then quickly change their mind and buy it back. A wash sale occurs when you sell stock, bonds, or other securities at a loss, and within a specific window, 30 days before the sale or 30 days after the sale, you do one of three things. Buy substantially identical stock or securities, acquire substantially identical ones in a taxable trade, or acquire a contract or option to buy substantially identical ones.
Okay, so you sell for a loss and jump right back into basically the same thing within that 61-day window. What's the penalty?
The penalty is that the IRS disallows the loss deduction on your tax return in the year of that sale. You can't claim that loss right now to offset gains or income.
Okay, so you can't claim the loss for tax purposes yet. But what happens to that disallowed loss? Is it just like gone forever? Did you lose the tax benefit completely?
No, thankfully it's not lost forever, it's just deferred. Publication 550 is very clear on this. The disallowed loss amount is added to the cost basis of the newly acquired, substantially identical security to shares you just bought back, the replacement property.
Okay. So it increases the basis of the new shares. Let's try a quick mini example for that one too. Say you bought 100 shares of stock A for $50 per share, so your basis is $5,000. The price drops, and you sell those 100 shares for $40 per share, getting $4,000 in proceeds. You realized a $1,000 loss. But then maybe 2 weeks later, you see the price bounce a bit, get FOMO, and buy another 100 shares of stock A for $42 per share, costing you $4,200. That's a wash sale, right? Because you bought it back within 30 days.
Yep, classic wash sale.
So your $1,000 loss is disallowed this year. What's the basis of the new shares you just bought for $4,200?
Okay, the basis of those new shares isn't just the $4,200 cash you paid. You take that purchase price and you add the $1,000 loss that was disallowed from the wash sale. So the adjusted basis of your new 100 shares becomes $4,200 plus $1,000, which equals $5,200.
Got it. So it's $52 per share basis now, effectively.
It effectively incorporates that deferred loss into the basis of the replacement shares. So when you eventually sell those shares in the future, assuming it's not another wash sale, your gain will be smaller or your loss larger because you're starting from that higher $5,200 basis. It's the IRS's way of making sure you don't get the tax benefit of the loss until you've truly exited the position by selling the replacement shares and staying out for at least 30 days.
That makes perfect sense. It prevents you from basically manufacturing a tax deduction while essentially keeping your investment position unchanged. It just pushes the tax benefit down the road.
Precisely. It's a complex rule with lots of nuances about substantially identical, but the impact on basis is the key mechanism for how it works. Now, another area the sources are starting to cover more, just reflecting the modern investment landscape, is digital assets. Crypto.
Yes, Bitcoin, Ethereum, all that. How does cost basis apply in that world? Is it different?
Well, the IRS Publication 550 now includes specific guidance on digital assets. And it states very clearly that digital assets are treated as property for federal tax purposes, just like stocks or bonds or property.
Okay, so property rules apply.
Which means the general tax principles we've been discussing specifically, calculating capital gains and losses when you sell, exchange, or otherwise dispose of them, apply directly. Just like with stocks, to figure out your gain or loss on a digital asset transaction, you absolutely need to know your basis.
And tracking that seems like it could be challenging.
Oh, potentially very. It requires tracking key information for every single transaction. The type of digital asset, the exact date and time you acquired it and disposed of it, the number of units involved, the fair market value of the asset in US dollars at the time of the transaction, and crucially, your basis in the specific units you disposed of.
So even if the reporting ecosystem from crypto exchanges isn't always as mature or standardized as it is for traditional brokers dealing with covered securities, they might not issue perfect 1099-Bs for everything. Yet, the fundamental requirement for you, the taxpayer, to track your cost basis is exactly the same.
Absolutely. And for digital assets, where you might have tons of small transactions, maybe transfers between different wallets or exchanges, different ways of acquiring them, like buying versus mining versus staking rewards.
Yeah.
Meticulous record-keeping of dates, quantities, and the US dollar value at the time of each acquisition event is absolutely paramount. It's the only way you'll be able to accurately calculate your basis when you eventually sell or exchange those assets. The burden is really on the taxpayer here.
Okay, so once you've navigated all these rules, whether it's symbol purchases, adjustments for dividends, dealing with covered versus non-covered, choosing an accounting method, handling wash sales, figuring out gift inheritance basis, or tracking crypto, and you figured out your cost basis for the assets you sold, you finally have to report it all to the IRS. Which specific tax forms are involved in bringing this all together on your return?
Right, the final step. The information flows from your broker's Form 1099-B and potentially your own detailed basis records onto specific forms that accompany your main tax return, which is usually Form 1040. The two primary forms for reporting investment sales are Form 8949, which is titled Sales and Other Dispositions of Capital Assets, and Schedule D, attached to Form 1040, which is Capital Gains and Losses.
Okay, Form 8949 and Schedule D. What's the relationship between those two forms? How do they work together?
Think of Form 8949 as the detailed worksheet or ledger, and Schedule D is the summary page. On Form 8949, you list out each individual sale or disposition transaction of a capital asset that you made during the year. For each separate transaction listed, you need to provide the key details. Usually a description of the property, like 100 shares of XYZ stock, the date you acquired it, the date you sold it, the gross proceeds you received from the sale. This usually comes from the 1099-B Box 11.
And the basis.
And critically, your cost basis for those specific shares you sold, from 1099-B Box 1M for covered, or your records for non-covered adjusted. Then you calculate the resulting gain or loss for that single transaction right there on the form. You'll often have multiple lines, maybe pages, of Form 8949 if you have many sales.
And the information from the 1099-B generally populates this form, at least for the covered stuff.
Yes. Ideally, the information for covered securities reported on your Form 1099-B, the proceeds, the basis, the dates, whether short or long-term, goes directly onto the appropriate section of Form 8949. There are different checkboxes on Form 8949, depending on whether basis was reported to the IRS and whether it was short or long-term. However, Publication 550 is very explicit that you also use Form 8949 to make necessary adjustments.
Ah, okay. So if the 1099-B is wrong or incomplete.
Exactly. This is where you'd manually enter the correct basis for non-covered securities where the broker didn't report it. It's where you'd adjust the basis reported by the broker to account for a wash sale loss deferral. Or it's where you'd correct a basis fault that you genuinely believe your broker reported incorrectly based on your own accurate records, though you might need to explain that. After listing all transactions and making any needed adjustments, you calculate the total gain or loss from all the transactions listed on all your Form 8949s, separating them into short-term and long-term categories.
Okay, so Form 89949 is really where you reconcile the broker's 1099-10B with your own records and reality, make any needed corrections or additions for things the broker doesn't know or track.
That's a great way to put it. It's the detailed reconciliation worksheet where you calculate the total capital gain or loss from all your reportable sales for the year. Then, the totals from Form 8949, your total short-term gains and losses summed up, and your total long-term gains and losses summed up, are carried over to Schedule D.
And what happens on Schedule D?
Schedule D combines these totals. It nets your short-term gains against your short-term losses and your long-term gains against your long-term losses. It also factors in any capital loss carryovers you might have from previous tax years. Ultimately, Schedule D calculates your net overall capital gain or loss for the entire tax year. And that final net figure from Schedule D is what is then reported on your main Form 1040 tax return, impacting your overall taxable income.
It really is a flow of information, isn't it? Starting with the actual transaction, captured hopefully by the broker on the 1099-B or your own records, then detailed and reconciled line by line on Form 8949, summarized into net figures on Schedule D, and finally impacting your bottom line tax liability on Form 1040. Understanding the pieces makes the whole picture seem much less intimidating, actually.
It truly does. It shifts it from being some kind of mysterious black box process driven by forms you don't understand to something you can actually follow, verify, and feel more confident about.
So let's try and bring this deep dive to a close by pulling together the most crucial takeaways. It seems like the absolute bedrock here, the starting point for everything, is just recognizing that understanding your investment's cost basis isn't optional. It's truly fundamental to accurate tax reporting.
Absolutely. It is the essential starting point for calculating gain or loss. Every single sale requires determining that basis number correctly. You just can't skip it.
And a key part of that, especially now, is knowing that reporting difference created by the 2012 rule change, understanding whether your security is covered, meaning the broker should report the basis on the 1099-B, or if it's non-covered, meaning the basis tracking is entirely your responsibility, potentially going back decades.
Yeah, that covered versus non-covered distinction is absolutely critical. It tells you immediately whether you can likely rely on the 1099-B as a starting point, or if you know you need to roll up your sleeves and dig out years of old statements and records. Big difference in effort.
And for those covered securities, recognizing that you often have a choice in how you calculate the basis when selling only a portion of your holding, using methods like average cost, FIFO, the strategic HFFO, or even specific identification is actually a powerful tax planning tool. It's not just passive, it can impact your current year's tax bill quite a bit.
It really can. The choice of method can significantly alter the reported gain or loss on a sale. And while the broker might have a default, be aware of and potentially utilizing other methods like HIFO for tax loss harvesting or SLIDE for precise control is, I think, a key piece of investor knowledge today. But as we said, remember that seeking professional advice for complex situations or significant strategic choices is often very wise. Don't just guess.
Good point. And finally, regardless of whether securities are covered or non-covered, maintaining diligent records yourself, especially for things like reinvested dividends, which happen automatically and add up over time, is paramount for ensuring your basis is accurate. And just being aware of how other events, like wash sales or receiving assets via gift or inheritance, impact basis is necessary for getting the complete tax picture right.
Yeah, by grasping these core concepts, what basis is, how it gets reported or doesn't, how it gets adjusted over time, and the different methods for calculating it when you sell, you're really no longer just a passive recipient of tax forms that show up in the mail. You become an informed participant. You're equipped to actually review the information provided by your broker, ensure its accuracy to the best of your ability, understand the tax implications of your investment decisions, and ultimately file your taxes correctly, potentially saving yourself money or, just as importantly, avoiding future issues with the IRS.
It truly is about transforming that moment of, tax season stress or confusion into one of empowered understanding. And thinking about the whole journey of basis tracking. I mean, starting from a simple purchase cost decades ago, then navigating stock splits, maybe mergers, years and years of reinvested dividends, potentially moving assets between different financial institutions. It really highlights the sheer logistical challenge involved in maintaining a perfect, unbroken historical record for some holdings.
Indeed. It's not trivial. Even with the advancements like the covered securities rules, which have helped immensely, the ongoing accuracy and accessibility of cost basis information, especially across very long holding periods and through complex portfolio activity like corporate actions or transfers, remains a significant undertaking both for the financial institutions trying to track it and for the investors trying to verify it.
Which perhaps leaves us with this final thought to chew on. In an investment world that is constantly evolving, with new asset types and complex financial products emerging, How much value should investors place on maybe simplifying their portfolio structure or their transaction activity versus the potential tax advantages they might gain through really complex basis tracking and utilizing sophisticated accounting methods? It feels like a balancing act, doesn't it? Between the ease of record keeping and the potential for tax optimization. It's a question I think every long-term investor probably faces at some point.
That's a very good question. A balancing act well worth considering.